Home prices are down, market time is up. Feels like a slowdown, right? Not exactly. When you look closer at the data, this isn't a market falling apart like the headlines or YouTube doomsayers are suggesting.
Then what is it?
It's a market catching its breath. And what happens next could set the tone for 2026, especially if you're planning to buy or sell here in San Diego. I'm Karl, your San Diego Realtor, and this is your San Diego Market Matters deep dive into the latest market data to see what's really happening here in San Diego. And if you haven't liked and subscribed to the channel yet, consider giving it a shot. This way you can stay up to date on the San Diego market. Enough said, let's jump into this. Sellers came out really strong earlier this year, flooding the market with new listings through the spring and summer, but that momentum is fading fast. Let's start with the new listing data to show you exactly what I'm talking about here. In October, detached new listings, these are your single family homes that share no walls. They came in at 1,762, down 1.6% from last year. That's the third straight month we've seen fewer detached homes hit the market compared to 2024.
So what does this mean?
Now that tells me that the seller comeback that we saw earlier this year has officially cooled off. Sellers are watching the market more carefully, and a lot of them are deciding to stay put instead of trading in their 3% mortgage for something in the 6s. Condos and townhomes saw a similar slowdown. Attached listings came in at 1,058, down 4.1% year over year, the first negative report of 2025. Since March, new attached listings have been trending down month after month, and now we're finally seeing that drop show up as a negative number. And here's where it gets really interesting. Even though listings are slowing, we're still up big picture. Over the last 12 months, detached listings averaged about 17% higher than a year ago, and the attached averaged 23% higher. That shows how strong the first half of 2025 really was. Sellers came back, but they've started hitting the brakes again. And fewer new listings means fewer options for buyers. So if you've been waiting for that perfect home to pop up, well, your odds are about as good as the Padres winning the World Series next year.
I have a chance.
But here's the upside. Most sellers are also buyers. So when they hold off, it gives first-time buyers a little bit more breathing room, with fewer move-up buyers competing in that same price range. Big picture, this slowdown tells us sellers are getting cautious again. If this continues through the holidays, which it likely will, inventory could flatten or even shrink heading into 2026. And that could set the stage for a tighter market just as buyer demand starts to warm up again. And speaking of demand, the next metric, pending sales, shows us exactly how active those buyers still are right now. Pending sales came in strong for October, but the trend beneath the surface tells a more interesting story. For detached homes, almost 1,300 pending sales, down 1.2% year over year. On paper, that looks like the market's holding steady, and honestly it is, but there's a shift happening. Through July, August, and September, pending sales were rising each month, growing from 2.7% to 9.6% year over year. But in October, that growth line broke, and when pending activity dips while new listings also fall, like we just saw, it means we're not adding new supply or new demand. Or in other words, the market's taking a breather. Now, when we line pendings up against new listings, the absorption rate for detached homes sits around 73%. Nearly 3 out of every 4 new listings went pending in October. And that's by volume, of course. That's still a very healthy rate for fall, and it tells us buyers haven't left. They're being selective. The slowdown isn't about weak demand. It's just about limited options. On the attached side, condos and townhomes recorded 690 pending sales, up 1% year over year. And that's roughly a 65% absorption rate by volume, which is softer than the detached side, but it's still steady for Q4. And here's what's eye-catching. Pending sales ticked up slightly while new listings fell 4.1%. This could be telling us that affordability is steering more buyers towards attached homes, despite them having HOA fees. And that side of the market might actually be benefiting from the high single-family prices. Now, when you zoom out over the past 12 months, detached pendings are up 1.6%, while attached are down 1.3%. Nothing dramatic, but it reinforces the same thing we saw in the new listings. The market's not hot, it's holding. And when you have steady pendings but shrinking new listings, that's a setup for tighter inventory heading into the winter. And if you want a real world example of that dynamic, look at Linda Vista, zip code 92111. Detached listings there didn't move at all in October, but pending sales more than doubled, up 133% year over year. That's super wild. When supply stays flat but demand spikes like that, it's a clear sign that buyers are still out there. They're just waiting for the right opportunity to pounce. Bottom line, this isn't a demand problem. Buyers are still showing up and they're still writing offers. They just have fewer homes to pick from. And the longer sellers sit on the sidelines, the more that balance will tilt once the next wave of buyers return after the holidays. Now, let's look at what actually made it across the finish line, the closed sales, because that tells us how many of those pending deals actually made it to the closing table. Closed sales in October came in at 1,321 for detached homes, basically unchanged from last year. That might sound as exciting as mashed potatoes without any seasoning, but in context, that's actually pretty solid performance for the fall. Historically, we start to see sharper declines by this point of the year, so holding flat tells us that deals are still making it all the way to the finish line, even as activity cools off. Now, here's where it gets a little interesting. Pendings have been trending flat to downward, and yet closed sales are holding steady. That means the pipeline of deals from late summer, when pendings were still strong, is still feeding through the system. In other words, buyers who went under contract back in August and September are sticking with those purchases. There's no mass fallout, no sudden drop in confidence there. On the attached side, we saw 673 closed sales, down 1.8% year over year, which again, for this time of the year isn't bad. Condos and townhomes tend to lag the detached market by a few weeks anyway, so this softer number just reflects that slower turnover. I don't think it's really anything to be alarmed with at this point. Now, if you line all of this up, new listings, pendings, and closings, it's a pretty balanced equation right now. We're not adding a ton of new supply, but most of what is hitting the market is still being absorbed and successfully closing. That's a healthy sign as we're wrapping up the year. The real takeaway here is consistency. The market's not firing on all cylinders, but it's still running smoothly. Deals are still happening, just at a steadier, more sustainable pace. With closings holding strong, that means the deals that are happening are sticking all the way to the finish line.
But what about prices?
That's where the data really sucks you in, because the median sales data for October tells a different story than most sellers expect right now. Detached median home prices landed a little over $1 million in October, down 2.7% from this time last year, marking the second straight month of negative growth. And that's despite rates being lower than they were the same time last year. So let's call it for what it is, a sign that affordability hasn't been fixed. A 0.5% drop in rates doesn't suddenly bring buyers flooding back into the market when everything else from gas to groceries is still eating away at their household budgets. And we're only 1 month away from this negative price growth becoming a trend. Now, even with this dip, detached prices are still barely positive for the year, up about 0.5 percentage point, and the 12-month rolling average is still sitting at 1% higher. So we're not declining, we're stalling. Buyers are more cautious, sellers are holding the line, and that result is a market that's drifting sideways instead of trending up or down at the moment. Attached homes tell a slightly different story. Condos and townhomes came in at a $660,000 median, down 2.8% year over year and negative across the board, month over month, year to date, and even the rolling 12-month average. That's not a crash, it's actually just compression. Buyers in this price tier are stretched to their limits, and sellers are having to meet them halfway. What all this really shows is that price movement has pretty much flattened out, even as rates have come down. That disconnect tells you something bigger. The market isn't waiting on interest rates anymore. It's waiting on confidence. Now, if you look at the higher end coastal markets like Del Mar, that's where you'll still see price strength, up nearly 7% this month. But that's the exception, not the trend. County-wide prices are holding, but they're not climbing, and that tells you that the market's in a bit of a standoff. Buyers are waiting for affordability, sellers are waiting for a signal that it's safe to list. And right now, neither side is blinking. Now, if the median prices told us the market's stalling, the average price data tells us why. Detached homes averaged just over 1.4 million in October, up about 4.4% from last year. And that's a sharp contrast to the negative median growth we just talked about. What that really means is the mix of what's selling is shifting. We're seeing fewer mid-range homes close and more higher-end sales holding up the averages. That's not appreciation, that's just composition of the market. So while it might look like prices are rising, it's really the upper tier buyers keeping the numbers inflated. These are the folks who aren't waiting for a Fed cut or mortgage rates in the fives. They're buying when they find the right property, period. Now on the attached side, condos and townhomes averaged around 806,000, down 1.2% from last year and almost perfectly flat year to date. That's the mirror opposite story. These are the buyers most sensitive to affordability and interest rates, and they're the ones setting the ceiling on what this market can sustain right now. So when you put these two together, the bigger picture is this. We're not watching prices rise. We're watching the market separate. Higher end demand is still strong enough to keep the averages steady, but entry level pressure is keeping the median from moving forward.
What are you trying to tell us?
And here's where the risk comes in. If that gap keeps widening into 2026, the top of the market could start to wobble. Luxury demand can hold prices up for a while, but not forever. If sales volumes keep thinning out and new listings stay low, we could see a slow deflation effect. Not a crash, but a drag, where the high end finally loses steam and the average follows. Now, this doesn't mean it's panic time, it's patience time, but the clock is ticking for something to give. Either affordability improves or prices eventually correct to meet buyers where they really are. Now, let's check out the days on market. This is the first metric usually used to determine the direction a market is going. Homes are taking longer to sell. That's one of the clearest signs that momentum is slowing down. Detached homes averaged 41 days on the market in October, up over 20% from last year. And attached homes hit 45 days, up 13%. So compared to last fall, most homes are sitting an extra week or two before finding a buyer. Now, normally when market time like that jumps, you start to see it show up in prices. Sellers start adjusting and median prices soften. But that's not what we're seeing in the price growth data that we just covered. Prices are basically flat, holding steady even though it's taking longer to sell. And that's really interesting because it means neither side is giving in. Buyers are being cautious but not panicking, and sellers are being patient enough to wait it out instead of slashing prices. So what we're looking at right now is a bit of a market standoff. Homes are sitting longer, but prices aren't exactly breaking. That's not balance, it's more like hesitation. If this pattern continues, it's something to watch closely heading into 2026, because eventually one side will blink. Either demand needs to pick up or sellers will have to adjust, and whichever one happens first will set the tone for the rest of 2026. Moving on with this updated version of the never-ending story for the San Diego housing market, total inventory tells us what's really happening right now. And it's not only about how many homes are on the market, it's about how quickly that growth has lost its momentum. Detached homes finished October with 3,083 active listings, down slightly from last year, about 1.5% lower year over year. But here's what's key. Back in March, detached inventory was growing at 80+% year over year. The rate of growth has been slowing every single month since. For attached homes like condos and townhomes, they are following the same path, up just 10% year over year in October after triple-digit growth earlier this year. That's a massive deceleration. So while total inventory county-wide is still technically higher than a year ago, the momentum is clearly fading. And when you step back and look at the bigger picture, just a little over 5,300 homes total for the county with a $3.3 million population. That's still an extremely undersupplied market. And let me paint a picture for you with this. Imagine it's January and the holidays are behind us. We've still got around, let's say, sub 6,000 homes on the market and interest rates drop by a half point. If just 1% of San Diego's population decides,
Hey, now we can finally buy,
that's over 30,000 new buyers entering the market with only a few thousand homes. Suddenly, that tiny inventory looks like a drop in the bucket. It's like musical chairs on steroids, and that's if only 1% decides to jump in. That's why prices haven't cracked here in San Diego like other parts of the country. There's just not enough available housing to trigger real downward pressure. We're seeing buyers with more time, but not more options. And if that changes even slightly, the whole supply-demand equation could tilt very quickly. All right, now let's zoom out and get the bigger picture here for the October totals. These are the combined detached and attached numbers in total. Across the board, numbers have been showing what we've been feeling for months. A market that's cooling in activity, but holding its ground in value. New listings came in around 2,820, down 2.5% from last October, and pending sales slipped 0.4%. Closed sales were also down half a point, so we're basically looking at a flat line. Slightly fewer homes hitting the market, slightly fewer going under contract, and slightly fewer closing. Nothing too exciting there. Now on the price side, this is where it gets interesting. The median sales price landed at $889,000, virtually unchanged from last year. The average sales price, though, actually climbed 3.4%, which tells us something. Even with fewer transactions, higher end homes are still moving and they're pulling up the averages. Days on market increased about 19%, now sitting around 43 days, which lines up perfectly with what we saw earlier. Homes are taking longer to sell, but sellers aren't panicking, they're holding the line. And total inventory rose just 3% year over year to about 5,321 active listings. With 2.8 months of supply, that's still well below what we call a balanced market, which would be closer to 5 or 6 months of supply. So to sum this all up, San Diego's market's in a bit of a stalemate. Buyers are more patient, sellers are more cautious, and the tug of war between affordability and supply continues. But here's the key takeaway. When both sides dig in, the market doesn't crash, it stalls. And right now, that's exactly what we're seeing. Before I close out, quick note on the data. Everything I share comes straight from the San Diego MLS. This is the same system every agent uses to list homes. I mention that because a lot of people online throw out numbers and they never show where those numbers come from. And honestly, it sounds like they're just asking ChatGPT to make up some of this stuff. The data I use is the real deal. It's straight from the source, there's no fluff, and there's no mystery map. And that's a wrap. I hope this data update was valuable and helpful for you to get a better pulse of what the market is doing here in San Diego. Be sure to like and subscribe if you haven't already. As always, I'm Karl, your San Diego Realtor. I'll see you in the next video.